You've probably had this trade. You short at the top of a range, the stock starts to fade, and you get that nice small winner. 2 days later, you do it again, and again it works. Then it occurs a third time, and you repeat this, except the third time, the stock blows through your stop, runs without you, and costs you in terms of a loss much more than the previous two winners. Now, the difference here is the market wasn't really trending those first two trades. It was a range bound market, oscillating. And the moment you forget that difference between a range bound market and a trending market, that's when that market stops paying you. Welcome back to the Physics of Trading. This is a 5-part course on the physics of how markets actually move. Episode 1 was motion, Episode 2 was about energy, and in today's episode, Episode 3, we're talking about oscillation, the piece of physics that explains why something like half of the markets on any given day refuse to trend versus the other half of the market. Now, a quick recap. A trend is a body in motion. A range is potential energy waiting to release. Today we add a third state to that. The body that doesn't go anywhere on net but moves the entire time, and that's what we call a pendulum. Or a spring, that might be another way you want to think about it. The market that gets you on both sides, so almost like a pendulum swinging day after day. In physics, an oscillator is any system with the stable equilibrium plus a force that pulls it back when it strays from that equilibrium. A pendulum hanging at rest, that's for example equilibrium. If you pull it sideways and gravity wants to bring it back, then when it overshoots, it swings the other way, gets pulled right back again, and this cycle continues until something dampens it. A spring is very similar in terms of how it works. This is called Hooke's law. Hooke's law states that the force is proportional to the displacement. If you stretch it, it pulls back harder. If you compress it, it pushes back harder. Mathematically, both produce the same shape on a chart, a sine wave. It goes up, down, right around the center line. So that's what we're looking for when we talk about an oscillation. Now, every single oscillation has 4 different properties. Equilibrium, which is the center it returns to. The second property is amplitude, which is how far it strays from the center before turning around. The third property is period, which is how long does one full cycle take. And finally, you have the fourth property, which is damping, which is how quickly the swings get smaller over time. So one more time, if we bring this back to, say, a pendulum, you imagine the pendulum with all 4 of these properties. Equilibrium is the center it returns to. Amplitude, how far does it stray from the center before it returns? So how far high or low if you were to imagine the pendulum. The period is how long does that full cycle take from one swing to the other side. And then damping is how quickly does that swing start to become smaller and smaller, getting closer to that center. Now let's bring this back to a stock. A range that holds for weeks isn't really a stock that you would call confused. Rather, it's a stock that has very clearly defined this equilibrium price, with buyers and sellers playing the role of the restoring force. If you push too far up, then the sellers are coming in. If you push too far down, then the buyers are coming in. And there's very clearly that equilibrium point, where price is oscillating around. The center is that equilibrium. Now the width of the range, if you imagine between the high of this range and the low of this range, that is what we would call the amplitude. The time it takes to go from the top of the range to the bottom of the range, so how long does it take to go back and forth, the whipsaw, that is what we would call the period. And finally, the slow tightening of the range, so the compression of this range, is what we would call the damping. Now, this happens constantly and often on names that, again, you don't expect to see coiled up. The squeeze we talked about in the form of energy is a great way to see where this compression might be happening. If you take something like XLP, the Consumer Staples ETF, through all of 2025, it essentially just oscillated inside of this very clearly defined band. Buyer stepped in at the lower bound, seller stepped in at the upper bound, and you had multiple of these full swings, but no real net direction one way or the other. Now, a sector ETF is designed to be defensive, doing exactly what defensive products do. So you would expect this to stay somewhat near the center as opposed to oscillating like we're seeing here. You take Lowe's, that's another example. From April through July of 2025, you'll see that Lowe traced basically a clean oscillation. Same idea, if you push too far high up, sellers came in, too low, buyers came in. Another example is inside of Yum Brands. From April all the way through December of 2025, you'll see Yum basically oscillates inside of this range, and this range lasts almost 9 months. The same restoring force, but again, just on a longer time period. Before we were seeing 4 months, now you're seeing a 9 month range bound price. Anyone who did try to trade this in the form of a trending market got chopped around to death of a thousand paper cuts. However, if you traded this like a choppy market, then of course you got paid repeatedly when you faded the edges. Now, the classic tool for spotting oscillation is the RSI. You've probably heard of it. It's the Relative Strength Index. And the classic terminology, again, is above 70 is overbought, below 30 is oversold. The problem is real markets don't really respect these numbers. You'll see that play out time and time again. In a strong trend, for example, the RSI can sit above 70 for many weeks. It can even do the 70, make a lower low, and then continue making a higher high. In a tight range, it might never even touch 70. So these fixed thresholds break the moment that the market changes any sort of its regime, its underlying market structure. Now, this is the fundamental limit of the basic RSI. The instrument doesn't adapt to the system that it's measuring. This is exactly what we built the dynamic RSI to solve. So it's a free indicator, but instead of the fixed 70 and 30 levels, we're now wrapping Bollinger Bands around the RSI itself. The upper band is where the stock on this time frame is genuinely stretched. The lower band is where it's again washed out. So this is the idea of now we're trying to measure the high and low of the range, the amplitude, to then figure out where can we actually fade price action. The dynamic RSI allows you to actually adapt as volatility changes, and like the basic RSI. Now, when those basic RSI bands again start to compress, you get a readout on the actual oscillator. And in the dynamic RSI, we have labeled this as a squeeze dot. So it becomes really easy to see when this price compression is happening. Not just on the actual price, again, this is on the RSI. So that tells you the RSI itself is starting to dampen, which usually precedes a regime shift. Now keep in mind in all of this, the RSI itself is measuring price. The dynamic RSI is not measuring price, it's measuring the RSI. That's what I think the secret sauce is, which makes it a much more useful oscillator than the basic RSI. And again, it's completely free. I'll leave a link to download it in the description box below, but hopefully this helps to explain why the dynamic RSI is useful, what it solves, and why it leads to fewer false over bot signals and trends, and it gives you cleaner mean reversion entries. Now let's talk about damping. Damping is what kills the oscillation. So if you imagine now, a pendulum in air slowly starts to slow down because air resistance is slowly stealing energy on every single swing. Same idea, same concept as on a guitar string. If you ever strum a guitar string, you'll see it vibrates and then slowly it'll fade to silent over time. The system has a finite amount of energy, and in this case, friction is taking portions and portions of that energy until there's none left. Now on a chart, damping shows up as a range that's gradually tightening, and the amplitude you'll see will start to shrink. Each swing is smaller than the last. And remember, amplitude is just a fancy way of saying the range between the high and the low. So as we start to see these swings start to become smaller and smaller, aka the amplitude collapsing, that means you're slowly starting to break out of this oscillation system and much more into a compression system. And that takes us to what we covered in the previous episode, which is energy. That oscillation starts to dampen, becomes compression. That compression then releases to turn into a new trend. Same body, but three different states in that body. Now there's one more piece that I think helps bring this together, give you a complete picture, and that's resonance. When you push an oscillator at its natural frequency, the swings start to get bigger, not smaller. A swing set, for example, is the obvious example. If you time that push right, you will get higher and higher. If you time it wrong, you'll stop swinging. Markets have these natural frequencies as well. Again, this is where you have the catalysts that are baked in, things like earnings cycles, even Fed meetings, monthly options expiration periods, triple witching Fridays. These external rhythms can amplify a stock swing or kill them depending on where you are in the cycle. The reason a stock might oscillate quietly for, say, 3 months and then suddenly start swinging twice as wide isn't that something fundamentally changed. It's this resonance term that we're talking about. An external rhythm has started lining up with the stock's internal one. As of this moment in this course, we have covered 3 different episodes. In the first episode, we talked about trend, where motion dominated. In the second episode, we talked about compression, where stored energy waits. And finally, in the third episode, we talked about oscillation, which is where the system swings around the center, aka a range-bound market. We have 2 episodes left. Episode 4, the next episode, we'll talk about temperature, which is the piece of physics that explains why Black-Scholes is mathematically a heat equation and what that actually means for how you would go about sizing trades. In the 5th and final episode, we'll take a look at the phase transitions when the market becomes a different market overnight. Until then, take this with you. Half the time, the market isn't going anywhere. It's just a range-bound market. And every range has a center, an amplitude, a period, and an eventual fade. The next time you see a chart that won't break out, don't fight it. Find where the center equilibrium line is, mark the oscillation bands, and let the oscillation actually help you pay on both sides until it stops being a range-bound market. I'll see you in the next episode.